Hi and welcome to my channel. For those of you new, my name is Dave and I work in financial services, and these videos are a mixture and journey towards my financial freedom. They will cover financial products and it will also cover financial well-being so you, like me, can hopefully reach your financial aims and goals sometime in the future. Now let's get into this latest video. This latest video is about my stocks and shares ISA review during the month of May 2022. For those new to the portfolio, our aim for this year is annual growth of 10%, to receive annual dividends of £1,200 and to end up with a year-end portfolio worth £80,000. Now, at the start of the month, we had a value of £59,240. At the end of the month, we had a value of £64,186, an increase of £4,946. Sounds good, but to the year to date, we're actually down 8.74%, mainly because our holdings in tech, in America and global funds. The reason why it went up was because we did put a contribution of £5,000 in the month. So for this tax year to date, we've made contributions of £10,000. Moving forwards, those contributions will reduce. It may well be between £5,000 and £1,000 a month, but the idea is to use our annual allowance of £20,000 by the end of April next year. In the month, our platform provider charges us fees of £10.49. If we look at the following chart on the portfolio, predominantly UK based, 59.71% in the UK, 24.82% in the USA and Americas, and 15.47% in Asia. And we've received some very good dividends in the month. During the month, we received a total dividend of £351.68. The year-to-date dividends, £465.27, and we only record the yield from our shares. Yield across our portfolio is 4.12%. In relation to the dividends we've received from the following companies: from NatWest, the bank, £33.37. From Aviva, the insurance company, £138.76. Now it would have normally been reinvested, but because it done a share consolidation on the same day, the facility was not available, so we will reinvest that at the start of June. And then finally from Lloyds, the bank, our largest dividend of £179.55, which gave us 403 new additional shares during the month. The following chart, predominantly based across financial services, the tech sector, but in the UK. So although it has received a loss of nearly 9% in the year to date, it's not as bad as it could have been because of the exposure to tech shares or the S&P 500 or global funds, but hopefully because it's UK based, it's a short-term blip. Now, if we look at the following, just going to go through where our holdings are held. So at the moment, we own 9 shares. £27,163 makes up 42.32% of our portfolio, of which 37.56% is in the FTSE 100 and 4.76% is in the FTSE 250. And across the 9 shares, 5 in profit, 4 in loss, but all bought as a long-term holds. Now our largest shareholding is Lloyds the bank. It was increased a month thanks to the dividend. We now own 16,097 shares, £7,200, 11% of our portfolio. Our next holding is someone we've increased recently, Legal & General, 2,750 shares, £7,140, again 11% of our portfolio. And we did actually top up during the month of £1,000 because it's given a very good yield of 7%, and that will pay out at the start of June. Our next holding is Aviva. We did own 944 shares. They did do a share consolidation, so for every 100 shares we now own 76. So we've now got 717 shares, £3,100, 5% of our portfolio, but we will reinvest that cash during the start of June back into Aviva's shares because it is paying a very good dividend of over 5%. Our next holding is Barclays Bank, 1,519 shares, £2,500, 4% of our portfolio. And then going slightly off track, we own 796 shares in Sainsbury's, the retailer, £1,818, 2.83%. Very good results recently, and a very good increase in its dividend, which will be paid out in the next few months. Our next holding is another share we've increased during the month, Card Factory, 2,817 shares, £1,816, nearly 3% of our portfolio. It did have very good results in the month. It has done a recent restructuring of its debt. Limited about what it can do moving forwards, but it is very cash rich. And once the debt will be cleared, they are free then to pay dividends. So it was bought as a good buying opportunity to increase an existing shareholding. Our next holding is HSBC, bought as a global bank, global diversification, 236 shares, £1,250, nearly 2% of our portfolio. Again, it does pay a very good quarterly dividend. Our next holding is another share we've increased, AJ Bell, our platform provider. We now own 432 shares, £1,235, nearly 2% of our portfolio. We did buy another £500 of shares in the month. They have struggled since we bought them. They are showing a loss of about 20%, but they had very good results in the month, very good figures, and it does pay a small dividend, but the dividend was increased. So that will pay out at the start of July. And then our final holding is NatWest Bank, 445 shares, just over £1,000, makes up 1.58% of our portfolio. So predominantly based across financial service insurance, but what we considered safe, secured, boring shares will hopefully give us some kind of growth. Everyone needs insurance, everyone needs banks. Interest rates will rise, hopefully profit margins will increase, but during the month, as we've explained, did pay us very good dividends, £350. So it does meet our objectives. Now, moving on to the funds held within the portfolio. At the moment, we own 13 funds, 7 in profit, 6 in loss. Total fund value of £35,892 makes up 55.92% of our portfolio. It was done because we were solely UK based when we started this portfolio. Okay, and a quick run through of our largest holdings. I'm not going to go through all 13 funds, but just a quick overview. Our largest holding is what we've increased recently. It's a passive adventures fund, so it'll across numerous sectors: the S&P, China, Europe, emerging markets, the United Kingdom. It was done for diversification. It's done because it's very cheap and it is giving us very good annual returns year on year. We did top that fund up, £3,000 in the month. Largest holding, £8,731, makes up nearly 14% of our portfolio. And our next fund is another fund we topped up. It's a Legal and General Technology Index Fund, £5,600, nearly 9% of our portfolio. Again, we did top up £500 a month as a result of the recent downturn in tech stocks. The S&P 500 is down 20% this year. Nasdaq is down 30%. So it was done to buy numerous shares. The portfolio owns 37 shares. It was done for diversification and hopefully some kind of recovery while prices were cheaper than what we initially purchased at. Our next holding is a global equity fund, £3,600, 5.6% of our portfolio. Has struggled recently, but again it was done for diversification and hopefully it will beat the market when it does recover. Our next holding is slightly selective. It's a positive change fund, £3,500, 5% of our portfolio. Has had very good run recently. Hopefully sentiment will be towards the sector moving forwards, but it was done for diversification and it was done because of the quality products it holds. Owns between 35 and 40 funds, but all good quality, safe, secure stocks, long-term holds within that portfolio. Our next holding is a US smaller companies, £3,000, 4.76%. Was showing a very nice profit, has been reduced lately, but again a very good hold towards the US sentiment. And then a fund which has struggled is a China fund, £2,900, makes up 4.6% of our portfolio. The fund's down about 20%. China has a very good or very poor run during the last 6 months. Hopefully sentiment will improve, but it was done for diversification and it's a fund we've got no intentions of selling. Ultimately, China will be a global player over the next few years, and they reckon it will become a big economy than America by 2030. And then our next holding of note is an emerging markets fund, £1,800, nearly 3% of our portfolio. Again, it was done for diversification. Now, other funds we hold, of note is a Russia fund. We put £500 in. It was showing at 650. The Russia-Ukraine conflict came. It's now down to £264. Has recovered in the month, but thankfully it makes up 0.41% of our portfolio. So it is showing a loss, but it does make up a very tiny percentage of our portfolio. But across the funds, 13 funds, some good funds in profit, some funds that have struggled just this 6 months, but hopefully will recover. And just like our shares, they're bought for a reason. They're all what are considered long-term holds. We're not going to sell them funds between the next 3 to 5 years, unless market sentiment completely changes or the management within that fund changes. So a quick overview. Our loss for the year to date, 8.74%, but we have made some contributions. We've bought at some good buying opportunities and we have received some good dividends a month. So hopefully it will meet our year-end objectives. £1,200 dividends and a year-end value of £80,000. The markets are long-term. We try and avoid short-term market sentiment. Remember, if you like the videos, smash the like button, subscribe to this channel, and we'll see you again soon.